Managing accounts receivable. So again, we've talked about cash. Now we talk about another component of working capital, which is accounts receivable. I will make a few statements here, and then on the next slide we will look at some numbers. The management of accounts receivables begins with calculating the average days of receivables and comparing this ratio with a firm's historical performance or ratios of comparable firms. So this comparison is critical. You first have to figure out what your average days of receivables are. So this refers to, on average, how long it is taking you to collect your receivables. If you are in line with industry standards or in line with the best companies in your industry, that's good. But if not, then we have an issue and we need to address that issue. The analysis of historical trends and significant changes in the aging schedule, and on the next slide I'll talk about the aging schedule, gives a clear picture of what is driving changes in average days of receivables. A firm must evaluate the trade-off between strict credit terms and the ability to make sales. So the point here is, if you try to reduce your accounts receivable or you are trying to reduce your days of receivable by imposing strict credit terms, so you are telling your customers that they must pay immediately or they must pay within 10 days, there is a trade-off between that and making sales. So your customers might then potentially go to a different supplier. So this trade-off must be taken into account. Overly strict terms may lead to less than optimal sales. Too lenient terms will lead to higher sales and higher receivables. So if you're very lenient, you might book higher sales but then have higher receivables, where there are two possible issues. One is that there is the risk of bad debts, and the other is that you forego interest. Now let's talk about the receivable schedule. Here is a basic idea, and I'm basing this on Exhibit 12 from the curriculum, which is on page 185. But one of the key things that you want to look at is, for every month, so let's say Jan, Feb, March, and let's say that we are in March right now, you want to see, you want to put your receivables into different buckets. So one refers to so your current receivables. So current means all receivables that are still not overdue. So if you have given terms that payments must be received within 30 days of sale, so those are current. And then you will have buckets like 1 to 30 days overdue, 31 to let's say, make it simple, 31 to 90 days overdue, and then 90 plus overdue. And you want to see then what percentage of your receivables fall within each of these buckets. So if you have a situation where you have 30%, 30% and 40%, this is the most dangerous cycle. Then you want to evaluate what is happening over time. So if you have a situation like, actually we should let's just make this 20 and this 10. So this is telling us a picture. This is a little bit scary in the sense that most of our receivables overdue are 90 plus, so the chances of bad debts are quite high over here. And then so this is sort of like a cross-sectional analysis. Then we also need to do the time series version and see how this is changing over time. So let's say that over time these numbers are going up and these are going down. So let's say over time this is coming down to 30, this is coming down to 20. So this is saying that our situation is actually improving. And remember, all these are percentages, so they will add up to so all these will have to add up to 100. So this is one sort of analysis where you look at the receivables in each bucket as a percentage of the total receivables. Then the next thing that you do is you try to come up with your weighted average collection period. And the way you do that is you look at, let's take the numbers for March, and let's say that in March your current is 30%, and then here you have 20 and 30. So this is your percentage of receivables in March. So let's see how we calculate the weighted days, that on average how long it is taking us to collect our receivables. So what we do for March then is say, on average, how many days outstanding do we have? So for each one of these numbers, we come up with the number of collection days. So how long does it take to collect? So let's say that the collection days here is 15. The number of collection days on average for the 1 to 30 overdue category, let's say, is 25. For the 31 to 90, let's say that the number is 75, and for 90 plus, let's say that the number is 110. So we then come up with the weighted number of days. So weighted number of days, so we multiply 30% by 15, 20% by 25, 30% by 75, 20% by 110, and we come up with all these numbers, and then we add up these numbers. So all these are added, and you come up with the weighted average. So this number is the weighted average collection days. So this represents how long on average it takes to collect the funds, and the idea being that all else equal, this is a number that you generally want to try and bring down, because this represents on average how long your receivables is tied up. If you have issues with this, I'd suggest that you take a look at exhibit 12 on page 185. This is in the 2011 CFA curriculum. Now let's talk about trade credit and customer receipts. So this basically means that when you sell to customers, you might set up different kinds of payment terms, and you just need to know the key terms here. 210 net 60 would mean that you are telling your customer that he gets a 2% discount if he pays in less than 10 days. So in 10 days or less. After that, the payment is due in 60 days. So payment is due in 60 days, but if he pays after 10 days and by 60th day, he is paying on time but does not get the 2% discount. Net 30 means that there are no discounts, the customer just needs to pay in 30 days. CBT stands for cash before delivery, COT is cash on delivery. There are different mechanisms that allow you to speed up your collections. One is called EFT, or electronic funds transfer, where money is transferred directly from your customer's bank to your bank. A lockbox system is a system where a customer mails payments to a given PO box, and basically these payments are then collected daily and deposited in your bank. You also need to know this term float factor, which is the average daily float for a company divided by average daily deposits. Float refers to the money that is in transit, so money that has been sent out by your customer but not received yet, so money that is still floating in the banking system, divided by, so you look at your average daily float divided by your daily deposits, and ideally you want this float factor to be low. Inventory management. So we've talked about cash, we've talked about receivables, now let's talk about inventory. Inventory management is an important component of effective overall financial management. Inventory levels that are too low will result in a loss of sale due to stockouts. High inventory levels will have high carrying costs and excess capital tied up in inventory. Reducing inventory will release cash, which can be reinvested in interest-bearing securities, or it could help you reduce your debt or equity funding. Large inventory can lead to greater losses from obsolete items which cannot be sold. And comparing average days of inventory and inventory turnover ratios between industries or between firms in an industry can be misleading. The point being that your inventory turnover ratios, while you want to compare it with your firms, with other similar firms, that's the ideal case scenario. It would be misleading to compare these numbers between two firms that are from a different industry. And even if the ratios are within the same industry, as you've seen in as you've seen in FRA, different companies might be making different assumptions about how they account for inventory. So you need to factor those differences before you make comparisons. Now, a quick point that's not mentioned in most study notes, but it is there in the curriculum, that when you manage inventory, there are a few important terms. So in the context of inventory management, let's look at time. So the point is this: most companies like to keep their inventory at least a basic level that is referred to as safety stock. So in order not to ever have a stock out position, companies, if this is 0, will have a certain safety stock where they say that we always want at least this much stock. So as inventory is used up, it is coming down. When we hit the safety stock, then companies reorder inventory, and the amount that is reordered, so the distance from here to here, is often referred to as the economic order quantity. So companies figure out what is the most economical amount to order based on a trade-off between the cost of inventory and the cost of funds that are and transaction costs. So based on the various costs involved, companies figure out an economic order quantity and order that. So simplistically put, the inventory balance will move like this. At times when the usage is high, we might just come down a little more, but these two terms I think are useful to know. There are courses where this material is covered in a lot more detail. For the CFA, as long as you know the basics presented on this slide, you are in good shape. Now let's talk about managing accounts payable. So we moved over to the liability side. Accounts payables must be managed well because they represent a source of working capital to the firm. If a firm pays its payables prior to due date or prior to date when they are due, a firm foregoes interest. Late payments will damage relationships with suppliers and lead to more restrictive credit terms. Extension of days payables may serve as an early warning of deteriorating short-term liquidity. So the most important takeaway here is that when you have an agreement with suppliers, try to make the agreement such that you pay after as long as possible and then make the payments on the last date. So that means also don't get late making payments. Now let's also talk about the economics of a trade discount. To manage accounts payables, the evaluation of a trade discount must be carried out frequently. As mentioned earlier, it is beneficial for customers to pay close to the end of the discount period. You can ignore the rest of the stuff here for now. Suppose if the terms are 210 net 30, this means that there is a 2% discount for paying within 10 days and the net amount is due by the 30th day. The cost of trade credit here is 109% if the credit is paid on the 20th day, but it is only 44% if paid on the 30th day. Now how do we get these numbers? Let's do this through an example. So let's do this together. What is the cost of trade discount if terms are 210 net 30 and the account is settled on the 30th day? Now here is a quick question. First of all, what does 210 net 30 mean? It means that you get a 2% discount if you pay by day 10, otherwise you have to pay the entire amount in 30 days. So just make a mental note whether you think it makes sense to pay on the 10th day or on the 30th day, and we will now figure out what the correct answer is. The simple way to look at this problem is, let's say you buy something worth 100, and what we are saying now is that essentially if you pay by day 10, then you are only paying 98, versus if you pay on the 30th day, then you are paying 100. So if you pay on the, so in one way of looking at it is that the item that you are buying really costs 98, because if you pay for it up front, or if you just pay for it in the first 10 days, you are only paying 98. If you are delayed, then you are paying additional interest of 2. Now if that $2 interest is being paid, what is the rate that you are paying? So the holding period here is 20 days. So the way you can look at it is the rate that you are paying is 2, so 2 over 98. So the interest is about 0.02, so that's about 0.02 or about 2%. Now this 2% is for so this is the 2% for this period, in our case a 20-day period, because we are assuming we'll pay on the 30th day. Now this 2%, how do we annualize this? So if 2% over 20 days, what does this become over a 365-day period? The way you annualize, and I hope you remember this from quant, is to say you have 1.02 raised to the power of 365 divided by 20. So this gives you 1.44 approximately. So what that means is that on an annualized basis, $1 becomes 1.44. So this is 44%. So if you are paying on the 30th day on an annualized basis, your rate is 44%. And that clearly shows you that the most sensible thing would be to actually take the 2% discount and pay 98 by day 10. And what you can do as practice now is, what if you just pay on the 20th day? If you do the same calculation, if you pay on the 20th day, then this distance becomes 10 days, and you will do 1.02 raised to the power of 365 over 10, which will give you an even larger number over here. So the point being that if for some reason you miss this date, then you will get the lowest possible rate by paying on the last day. So important example which might have seemed slightly unintuitive initially, but key point is that you try to make the payment right here. Objectives of short-term financing. So number one, the number one objective is to ensure sufficient capacity to handle peak cash needs, maintain sufficient sources of credit or alternate sources, ensure rates are cost effective. So just to put this in context, we are now on the liability side. We just talked about accounts payable, which is one type of liability, but the good thing about accounts payable is we don't pay interest. Now another source of financing is typically bank financing, where you try to get short-term credit from a bank, and essentially you want to ensure that you have short-term arrangements in place so that any immediate needs that you have you can handle. And when you do this, you want to make sure that your sources of short-term financing are cost effective. That means that you aren't paying too much interest or too much transaction costs. Short-term funding from banks. I think in your study notes as well as in Shweza, as well as in the curriculum, there will be a few lines on each one of these items which you should know, but I'll just explain this briefly. An uncommitted LC means uncommitted line of credit. This is a source of short-term funding because your bank is saying it will lend to you, but the dangerous part is that it is uncommitted, which means that even though you might have a letter of credit, but if the bank decides not to fund you, then because it's uncommitted, it can legally stop funding you when it wants to stop. So when situation gets bad, this source will dry up very fast, hence risky. Committed letter of credit is better. This is where the bank is committing that it can lend you a certain amount over a certain period of time. So this is a better state to be in. Revolving letter of credit is one where you take credit, you pay it off, and then you are again eligible for a certain amount of credit. Another scenario is asset-based loans, where you get a loan from a bank and you pledge assets. So you might pledge your property or your building or equipment, and the bank essentially holds a lien then against your asset, and based on that asset, which is collateral, you get a loan. Bankers' acceptance are used by firms that export goods. There is a lot written on this, but I think at this stage, as long as you just understand the basics, that's fine. The basics are that for an exporting company, it might be a while before it will get the money from the importer, but instead they get a banker's acceptance from the importer's bank committing that the exporter will get the funds. So that document called the banker's acceptance then can be used as a basis for raising money. Factoring means the sale of receivables. So a company with certain accounts receivable on the balance sheet might essentially sell the receivables and receive cash, though more typically this might be viewed as a financing transaction, because if the bank retains the risk of not receiving these receivables, then if the company has the risk of not getting these receivables, then essentially what the company has done is shown the receivables as collateral and borrowed based on that collateral. So you might recall that in the CFO segment of the cash flow reading, we talked about this. Here all you need to know is that factoring, which is the sale of receivables, is also a way of raising funds. Non-bank short-term financing, not as popular. All that is saying is sometimes there are some non-bank finance companies from which you can raise money. Sometimes large companies issue commercial paper, which means because commercial paper is a company issuing the equivalent of a T-bill. So a company might issue paper which is a 90-day paper, where a company says, give me say $900 today, and after 90 days I will pay back 1,000. So this might seem like a very high interest rate, but nevertheless, to illustrate the point, this is sort of like a T-bill. Now, if you've understood all these points and you are feeling brave, I'd suggest that you look at example 7 in the curriculum, because that gives you a few numerical examples of dealing with different kinds of funding sources. So the point being that if you have different funding sources like a banker's acceptance, letter of credit, and so on, you need to evaluate the overall cost of each one of these sources, and the cost might include interest related costs, commission, transaction costs, etc. So a corporate finance executive needs to understand the total cost before deciding which sources of funding are best for his or her company. So that brings us to the end of this reading. As always, practice as much as you can. Many of the curriculum examples are good, so do those. Make sure you do the problems at the end of the curriculum reading as well as in your study notes. If you have any comments, please post them on YouTube. If you like this video, click on the like button. Thank you, and that is it for now.